I'm Frederick Middlebrooks. I'm a licensed loan officer in Georgia and in Florida, and I am tonight going to be presenting information on upfront mortgage costs and strategies that you can use to save on those upfront costs. You will want to stay tuned to the end because I am going to talk a little bit about one particular way that you can save big, especially when it comes to your interest rates. And this particular method is one that a lot of people are not aware of. So please do tune in to the end. And if you are one of the people that did tune in live, there is going to be something that I'm going to show you at the end, a little peek behind the curtains when it comes to interest rates and pricing. So I'll let you see a little bit about what we actually see from the mortgage side. But if you're watching this as a recording, you won't be able to see that. You'll have to tune into the live presentation to be able to see that. But if you are here live, stay to the end for that as well, because it'll be pretty interesting for you to be able to see how we price out loans and how your mortgage discount points and everything come together. So I'll share that with everybody live in the presentation that tuned in tonight to watch this live. So upfront mortgage costs and strategies to save big. Let's get on into it. So understanding your mortgage costs. These are things that factor, or I guess you could say compile your mortgage costs that you pay up front. So you've got your down payment, closing costs, interest rates, and interest rates, the discount points with the interest rates is what you actually pay, or the cost that you pay on that front. And you've got property taxes and insurance. You may also, if you've ever been through the home buying process, or if you are looking to go through the home buying process, you might hear of prepaids being something that you need to pay for. And prepaids are basically property taxes and insurance. So property taxes and homeowners insurance have to be paid up front or in advance of when they are actually needed. So for example, you have to have 1 year of homeowners insurance that we pay up front, and then we also collect a couple months of property taxes and insurance to put into an escrow account, so that when insurance and property taxes are due the next time, there will be enough money in there in addition to what we take out of every month's mortgage payment, so that we can pay those again on your behalf. But when we pay those in advance, that's why we call those prepaids, because we're prepaying them before the time period for which they are utilized. So those are your prepaids, property taxes, and insurance as well. So these are all the things that factor up your mortgage cost. There may also be one other thing in here, which could be your HOA or your homeowners association. Not all houses have a homeowners association, but if yours does, we do also factor that into your mortgage cost as well. So I'll get a little bit more into the particulars of how these play into the different loan types. So we'll get into that next, choosing the right mortgage. So FHA is pretty much common amongst first-time home buyers. It's often thought of as being a first-time home buyer loan because a lot of first-time home buyers choose FHA for the mortgage program or the loan product that they use to purchase their first home. It has a lower down payment than what a lot of people may find with conventional, even though you might be surprised to know that you can actually get a 3% down payment with conventional, which is a 0.5% less than what you can with the FHA. However, interest rates are also better with FHA as well. And then you have VA, the best loan product out there for veterans or active duty military. And then you have what's called non-qualified mortgages. Non-qualified mortgages are mortgages that where the qualifications do not fit the traditional qualification methods for qualifying for a home. By that, I mean, when you typically qualify for a home purchase, we are looking at your 2 years of W-2s. If you are a W-2 employee, we're looking at your last 2 years of W-2s, last 30 days of pay stubs. We need 2 months of bank statements. And we pull your credit as well to see what your credit score is. However, if you're going through a non-qualified mortgage, there are ways through a bank statement program, for example, where you might not have to supply any W-2s. Or if you're self-employed, you don't have to supply your tax returns. We just look at your bank statements. We look at your credit score as well to determine whether or not you qualify for that loan. A DSCR, or a debt service coverage ratio loan, is an investor loan, which is also a non-qualified mortgage because you don't even have to show income for a DSCR loan. You can buy an investment property just based off of having enough assets to cover down payment and any reserves that might be required, as well as having a high enough credit score. And the rest of it is all determined based on how much the property is going to rent for, but we don't even look into your income. So when we look at those non-traditional methods of being able to qualify for a home, those are called non-qualified mortgages. But when we look at your W-2s, your pay stubs, your tax returns, your bank statements, when we take all of that information in addition to your credit profile, those are typically your traditional qualified mortgages, such as your FHA, your conventional, and your VA loan. So with these loans, what you want to consider are the down payment requirements. And this goes into the upfront cost, which is the gist of everything that we are talking about this evening. So factors to consider with the down payment: FHA minimum down payment requirement is a 3.5% down. Now, I'm not going to get into down payment assistance, but I will say that even if you do get down payment assistance, that doesn't remove that 3.5%. That just pays the 3.5% on your behalf. And there are a lot of other stipulations that go along with down payment assistance. But the down payment requirement for a FHA, regardless of whether or not you're using down payment assistance or not, it is 3.5% of the purchase price of the home. Conventional can vary a lot with the down payment. You can have as low as 3% if you're a first-time home buyer and you qualify for one of their programs with a 3% down. You could also have a 5% or a 10%, or if you want to go up higher, you can go up higher as well. VA does not have a down payment requirement. And for your non-qualified mortgages, you will typically have a higher down payment. And that's something to keep in mind if you are wanting to qualify without having to show income, or you're wanting to qualify just based on your bank statements because maybe you're self-employed and you have too many write-offs to qualify via your tax returns. A bank statement loan could be the option for you. However, it's important to know that you might end up paying a 15% down payment for that home. So if you're looking at, say, for example, even a $200,000 home, that's $30,000 that you could be paying on that $200,000 home if you're taking the route of a bank statement loan and you have to put 15% down because you're doing a non-qualified loan. So those loans do come with higher down payments, often 15 or 20%, and it could be higher as well. Mortgage insurance. All of these FHA has mortgage insurance, and that is required regardless of how much you put down. Now, if you put down at least 10%, then that mortgage insurance can fall off after the first 11 years. But again, you would have to put down at least 10% on that home in order to have that mortgage insurance fall off after that first 11 years. But in any case, you will have mortgage insurance for at least 11 years on that FHA loan, possibly for the life of the loan if you put down just the 3.5%. For a conventional mortgage, you will have mortgage insurance if you put down less than 20%. But that mortgage insurance can fall off later on. However, again, that's a cost that we do have up front with those mortgages. VA does not have mortgage insurance. You might be getting a little bit of the gist of why I say VA is one of the better loan programs out there. No down payment requirement, no mortgage insurance required. Non-qualified mortgages. A lot of times your non-qualified mortgages won't have mortgage insurance. And the reason is because your down payment is so high. So with some of these loans, you might have a 20% down payment requirement. Oftentimes when you're putting 20% down on a home, you don't have to have mortgage insurance, just like with your conventional loan. If you put 20% or more down, you don't have to have mortgage insurance. So a lot of your non-qualified mortgages, you do want to check, but in many cases, they will not require mortgage insurance. So another cost, and this is not so much a huge cost that I would anchor a decision off of, but just something to be aware of, are your appraisal costs. And with that, you will pay more or less, depending upon the type of loan product that you choose for your appraisal. For example, an FHA appraisal may cost a little bit more than what a conventional appraisal would be. And a non-qualified mortgage appraisal, for example, if you are doing an appraisal for a DSCR loan, or a debt service coverage ratio loan for investors, that appraisal has an extra layer to it. So in addition to appraising the house for how much the house is actually worth, you are also going to be doing an appraisal for the fair market rental value of that property as well. So if that property rents, let's say the mortgage is going to be $2,000, there has to be another appraisal done to see how much that property would actually rent for in the fair market, to determine whether or not that loan can be made, or how much your interest rate would be if it rents for enough to cover the mortgage, or if it rents for enough to cover 75% of the mortgage, or if it rents for less than 75% of the mortgage. All of those have different interest rates associated with them. So that's why that extra appraisal is done there, and that comes with an extra cost as well. Again, not something that I would anchor my decision off of when it comes to just the appraisal cost, but it is an upfront mortgage cost that you want to be aware of. And then there's the interest rate, and I will definitely get in a little bit more into the interest rates and all the costs that are associated there. But what I will say right now is that there are discount points, and that is how we determine how much you will pay for a particular interest rate. So the higher your interest rate, the less you have to pay in discount points. But again, you have a higher interest rate. If you want a lower interest rate, you will typically have to pay more in discount points up front to get that lower rate. But then over the life of the loan, that can make itself up in value, and you can end up paying less over the life of the loan if you do buy down that rate. So I'll talk a lot more about that, so that you'll get, again, if you're tuning in here live, you'll get to peek a little bit behind the curtain and see how we factor in those interest rates and discount points and everything. So effective budgeting. I am not going to tell you how to spend your money. However, I am going to advise on a few ways that you can effectively budget to help save for down payment, closing costs, and all of these upfront costs that we have. And then after this slide, I'm going to also talk about ways that you can also save money in addition to what we're about to go over here. So consider cutting out your streaming services. I know that's hard for a lot of people, because a lot of people like to binge watch whatever the popular shows are that are out there on TV. However, there's a lot of free content that you can get out there for YouTube and Roku. Roku actually has a lot of free shows out there. You can download their app for free, set up an account for free, and watch shows for free on Roku. And there's some other streaming services that allow that as well. It might not be some of the most popular shows that are out there, but living a little bit below your means of where you would like to be is going to help set you up for building the wealth and attaining the home ownership goal that we have, that we're trying to shoot for. So cutting out some of those paid streaming services, reducing how much you go and eat out at restaurants or Starbucks, those are things that also add up over time. Considering a prepaid phone plan. So on that one, I will say that a few years ago, probably about 4 years ago now, I switched to a prepaid phone plan. Before that, I always had a regular monthly plan that you pay for. You use your phone and then you pay the bill. Prepaid is something that a lot of people tend to shy away from because, well, one of the reasons is because they don't have unlimited data that you can use. So with the prepaid plan, I pay $50 a month for 2 lines. So that's a line for myself and my wife. And so we have 2 lines and we pay $50 total for both of them. So they're $25 a piece. And with that, we each have 5 gigabytes of data. Unlimited talk, unlimited text. I can tell you with certainty that in the last couple years that we've had these prepaid phones, we have never gone over that 5 gigabytes of data in a month, because 90-something% of the places that we go to or are at have Wi-Fi. So we always hook up to wherever the Wi-Fi is where we're at, and we're never using our own data unless we're actively in the car driving somewhere. So look into getting a prepaid phone plan, because that could save you a lot of money, and you get all the same perks of being on your same cell service, because odds are whoever your carrier is, they have prepaid phone plans. So it's something worth looking into, because you could save $20 a month, $30 a month, and not even have to experience any change to your service or to your data or anything like that. So that's something that you'll want to consider. And reducing your utilities. Perhaps you change what that thermostat says set to all the time. That can really affect your bill. Making sure lights are off in rooms when you're not actively using the lights in those rooms and things like that. So these are things to just effectively help you budget your money better, to be able to save for that down payment, because we're not talking about saving $1,000 or $2,000. You need to be saving 15, 20, in some cases 25 or $30,000 to cover all of the costs associated with purchasing a home. And that may be a shock to a lot of people. However, home prices are getting more and more expensive, and the cost to purchase those homes are also going up as well. Appraisal costs have gone up. Closing costs have been going up. And as home prices increase, that means your down payment is also increasing. So you need to be prepared by having that amount of money saved up. If you're not saving 20,000, 25,000, 30,000, then now you're either looking to the seller to help you out with closing costs, or you're looking to down payment assistance programs, which come at a cost. Again, not going to get into down payment assistance, but they come at a cost, sometimes a pretty steep cost, just for someone else to step in to help you pay for those expenses or those upfront costs. So you want to make sure, as much as it's dependent on you, to have that money saved, because even if the seller is willing to help you, if you do get into a multiple offer situation, you lose a lot of leverage in having your offer be the strongest offer if you're putting up an offer asking for the seller to cover half your closing costs, and someone else that already has the money to cover the closing costs, they can negotiate better with the housing price there. So those are some budgeting tools, and this is some stuff that's important to remember with the budgeting. You want to track every single dollar that comes in and goes out. So everything that you make, have an assignment for it. Know how much goes toward rent, how much goes toward food, how much a good estimate should go towards utilities and gas or whatever it may be. Track every single dollar, because one thing that tracking every dollar is going to do is going to make you more intentional about how you spend your money, and you'll be much better at being able to save that money. And with the savings, make sure it goes into a savings account. You don't want to just, okay, I didn't go to Starbucks this week, so I saved 20 bucks, and you don't show that 20 bucks anywhere. If you save 20 bucks, take that out of your checking account, assuming that's your regular operating account, and move that into a savings account. And now you can actually have an account where you see those savings starting to grow, and you're saving up that money for your down payment and closing costs. So other savings opportunities that we have. One is that we have the, let's see, closing cost, interest rate buy downs, and price reductions. So these are 3 savings opportunities that all are weighted differently, but they have varying levels of impact when it comes to how much you pay up front versus how much you save over the life of your loan. For example, let's say that the seller is willing to pay $10,000 towards closing costs, or the seller is willing to drop the price of the home $10,000. Those are going to have differing effects on how much you pay up front. For example, if a seller puts all $10,000 toward closing costs, that's really going to help you out up front with not having to have that $10,000. However, in the long run, it's not going to do a lick of any good towards reducing your monthly mortgage payments, because closing costs have 0 effect on how much you pay every month for that mortgage. However, a $10,000 price reduction does, because now that mortgage is based on $10,000 less of a principal balance, and that does have a small effect on your mortgage. $10,000 toward buying down your interest rate 1 percentage point has an even bigger effect on how your mortgage, how much you pay monthly in that monthly mortgage payment. So even though you might pay more upfront by $10,000 in your closing cost, with your monthly mortgage payment over time, you will make up that $10,000 plus so much more, because you bought down that interest rate, which affects your monthly payment for the life of the loan, if it's a permanent buy down, or even if it's a temporary buy down, meaning let's say you do a 2-1 buy down For the first 2 years, you have 2 percentage points less than what the note rate is. So let's say your interest rate is going to be 7%. For the first year, you would pay a 5%. For the second year, you would pay a 6%. And then for the third year, throughout the remainder of the mortgage, you would pay a 7%. But for those first 3 years, you're paying a much reduced mortgage payment. So because of that, you're afforded those opportunities to save upfront. And then let's say interest rates drop in a year or a year and a half or 2 years from now, you can refinance into that lower rate. And check this, even with a 2-1 buy down, let's say that in the first year, you have a 5% interest rate because your note rate is 7%. So the first year is 2 percentage points less. You have a 5% for that first year. And let's say the second year, interest rates drop to 5%. And you're like, man, now my interest rate's going to go to 6%. But it doesn't have to, because with the 2-1 buy down, the interest that you saved for those first 2 years has already been paid in advance by the seller. So what that means is that it's already been paid for. So you can use the remaining balance of that 2-1 buy down that you haven't used yet for that second year. You can put that towards paying for your refinance, and that can permanently buy you down to that 5% interest rate, assuming interest rates drop to 5% for that second year. And it was paid for partially by that 2-1 buy down that your seller paid for, and you're using those funds that you haven't used for that second year to permanently buy your rate down to the 5, so it never goes to the 7. And so these are some ways that you can save on those upfront costs, but also considering perhaps not saving on the upfront, but saving over the life of the loan as well. So it's a give and take game. You know, where is it that you need the most assistance? If you're not able to purchase the home because you don't have any money in the bank, then yes, you want to push all that money up front so that you can get the property. That would be object number one that you want to make sure you secure, is the home. However, if you do have money that you're able to put down, and you can put whatever concessions that the seller may be willing to pay up front, or excuse me, if you're able to put whatever concessions that the seller may be willing to pay towards buying down your rate, whether that be a temporary buy down or a permanent buy down, those are some things that can really help you long-term save thousands or tens of thousands of dollars over the life of the loan. So the one thing that I was mentioning that a lot of people are not aware of is a big way that you can save a lot on your mortgage. It's called assuming the seller's mortgage. A lot of people are not aware that many mortgages are assumable, and just about all government loans are assumable. So what I mean by that is that, let's say, for example, you have a seller who purchased a home in 2019, 2020, 2018 even. Interest rates were much lower during all of those years than what they are today in 2023. And so if you go and purchase a home from a seller who bought their home with a much lower interest rate, ask the seller, hey, do you have an FHA loan currently? Ask them if they have an assumable mortgage, because if their mortgage is assumable, it may be worth it for you to look into just taking over their mortgage. Because if they currently have a 3% interest rate, you're not going to get a 3% interest rate today. So rather than going and getting qualified to purchase that $300,000 or that $400,000 home at a 7% interest rate, maybe that seller only owes about $250,000. Now, they may still be selling it for $300,000, but they only owe $250,000, and they have a 3% interest rate for that $250,000. So what you can do is you can purchase, or you can assume their $250,000 mortgage at that 3% interest rate. Now, for the other $50,000 that you'll need to come up with, you can get a second mortgage, unless you have $50,000 that you can put towards it in cash, because you will have to still pay $300,000 for the house if it's selling for $300,000. But if the seller owes $250,000 on their mortgage, rather than getting a completely new mortgage, look into seeing if the seller has an assumable mortgage, and then you can take over their mortgage payments and you get that 3% interest rate. rather than going and getting a new higher interest rate. And that can save you a ton of money and also save you on closing costs, because we're not originating a new loan. We being, lenders, we're not originating a new loan. We're transferring the loan that's already in place. And if you just need to get another second mortgage for a smaller amount to cover that 50,000 or that 80,000 or that 100,000, whatever the gap is between what the seller is selling the home for and how much they currently owe on the home, then you can look at getting the higher interest rate for just that portion of it, but you don't have to get a higher interest rate for the entire loan. So that's something that you definitely want to look into as well, that again, a lot of people don't know about, but it's worth it to ask about assuming the seller's mortgage. So that is all I have if you are not tuned in live right now. I will put it that way. So thank you for tuning in. I greatly appreciate it. And hopefully we see you on the next webinar.